Thank you, and welcome to the Briefcase, where we talk all things business, investing, and real estate. Today, we're going to be talking about the different sectors in commercial real estate, whether it's retail, office, apartments, condos, or warehouses. Let's get into it. This is why apartments make millionaires. This is the smartest asset in real estate. If you had to pick one real estate asset to build long-term wealth, apartments might be the smartest choice, and here's why. First, consistent cash flow. Unlike single-family homes, apartments spread risk across multiple tenants. One vacancy doesn't kill your income. Your property keeps producing. Second, scalability. Managing 10 units in one building is far more efficient than owning 10 separate houses. Lower operating costs, and centralized management, and better margins. Third, forced appreciation. Apartment values aren't based on comparable sales. They're based on income. Raise rents, reduce expenses, and increase NOI. And you directly increase the property's value. Fourth, inflation hedge. As prices rise, so do rents. Your debt stays fixed, but your income grows, creating powerful leverage over time. And finally, the tax advantages. Depreciation, cost segregation, and expense write-offs can significantly reduce taxable income. Apartments aren't just real estate, they're businesses. And if you understand how to run that business, you're not just buying property, you're buying financial control. Alright, quick fun fact about apartments that might completely change how you look at them. Did you know that over 90% of millionaires in real estate built their wealth through rental properties? Not house flipping, not wholesaling, but long-term holds like apartments. And here's the crazy part. Most of them didn't get rich because the properties doubled in value overnight. They got rich because of something way less exciting, but way more powerful. Cash flow plus time. Think about it like this. If you own a 50-unit apartment building and each unit only nets you $200 a month, that's $10,000 every single month in income. That's $120,000 a year from one property. But it gets even better. As rent slowly increases over time, your income grows while your mortgage stays the same. So every year, you're making more money. Your tenants are paying down your loan, and the property itself is going up in value. That's why apartments aren't just real estate. They're literally wealth machines. This is why smart investors choose condos over everything else. If you're looking to enter real estate without taking on massive risk or operational headaches, condos might be your smartest move. First, there's a lower price point compared to single-family or multifamily assets. Condos often require less capital up front, which means faster entry and easier scaling. Second, maintenance is simplified. Exterior is upkeep, with landscaping and maybe even roofing, typically handled by the HOA. That translates to fewer unexpected expenses and more predicted cash flow. Third, location access. Condos are often in high-demand urban or vacation areas, places where single-family homes are either unavailable or unaffordable. That drives stronger rental demand and long-term appreciation. And fourth, financial flexibility. Lenders often view condos as less risky due to the shared ownership structures, especially in well-managed associations. And finally, portfolio diversification. Condos allow you to spread capital across multiple units instead of concentrating risk in one property. Condos aren't just starter properties. They're strategic assets when used correctly. Quick fun fact about condos that might surprise you. Some of the world's wealthiest real estate investors actually prefer condos over single-family homes. And it's not because they're cheaper. It's because condos are time-efficient assets. Think about it. No lawn to maintain, no exterior repairs, no worrying about roofing or siding. All of that is handled by the HOA. For investors, that means fewer headaches and more scalability. In fact, in high-demand urban areas, Condos often have higher rental demand because they attract young professionals, travelers, and downsizers, people who value location and convenience over space. So while everyone else is chasing big homes, smart investors are quietly stacking condos because they know less maintenance plus high demand equals a much smoother path to cash flow. Not exactly what you expect, right? This is why smart investors own the retail buildings, not the business. Most people think retail is risky, but they're looking at it the wrong way. You don't need to own the business. You need to own the building instead. Here's why this matters. First, predictable income. Retail tenants often sign long-term leases, 5, 10, even 20 years. That means consistent cash flow, often with built-in rent increase. Second, triple net leases. In many retail deals, the tenant pays the taxes, insurance, and maintenance. That shifts the majority of expenses off your plate and turns your property into a low management asset. Third, location leverage. Retail thrives on visibility and traffic. If you own a well-positioned corner or a high-demand strip, your property becomes incredibly valuable, regardless of who the tenant is. Fourth, tenant improvements. Retail tenants invest heavily into the space, build-outs, branding, and infrastructure. That increases your property's value without you paying for it. And finally, exit flexibility. You're not tied to the failing business. If a tenant leaves, you replace them. The real asset is the land and the building that still holds value. The smartest investors don't chase trends. They control the real estate underneath them. Quick fun fact about owning retail that might completely change how you look at wealth. Some of the richest investors in the world don't actually own the businesses you see every day. They own the buildings that those businesses sit in. Think about it like this. McDonald's is often called a burger company, but in reality, it's one of the largest real estate companies on the planet. They make a huge portion of their money not from selling burgers, but from owning the land and charging rent to franchise owners. So while most people focused on owning a business, dealing with employees, inventory, and risk, smart investors often stop one level above and own the real estate, collecting consistent income, no matter how the businesses perform. In other words, when you own the building, you're getting paid, whether the store is packed or barely hanging on. That's where real power is. And this is why owning office buildings still makes millionaires, even in 2026. Most people think office buildings are dead. That's exactly why smart investors are paying attention. When you own the building and not the business inside, you control a powerful income-producing asset. Office properties typically come with long-term leases, often 3 to 10 years. That means predictable, stable cash flow compared to residential turnover. Second, tenants pay more of your expenses. In many office leases, especially triple net, the tenant covers taxes, insurance, and maintenance. That shifts risk off of you and increases your net income. Third, office buildings offer scalability. One acquisition can generate income from multiple tenants under one roof, diversifying your risk instantly. Fourth, there's value add potential. Small improvements like modernizing interiors or re-tenanting vacant space. You can significantly increase your building's valuation, sometimes by hundreds of thousands. And finally, depreciation and tax advantages. Thinking like a CPA, I'll tell you, commercial real estate can offset income in ways most assets simply cannot. The truth? Office buildings aren't dead. They're misunderstood. And in every misunderstanding, there's a market. And that means there's opportunity. Quick fun fact about offices that most people don't realize. Some of the wealthiest real estate investors don't actually care that much about the rent from office buildings. At least, not in the way you think. What really makes them millionaires is something called forced appreciation. See, unlike houses where the value is based mostly on the nearby homes. Office buildings are valued based on how much income they produce. So if an owner buys an office building and income increases, maybe by raising rents, cutting expenses, or bringing in better tenants, the value of that building can jump massively. For example, increasing annual profit by just 100 grand could raise the building's value by over $1 million or even more, depending on the market. And that's not speculation, that's math. And that's why even in 2026, when headlines say office space is dead, smart investors are quietly buying underperforming buildings, improving them, and turning them into serious wealth machines. It's not about the building, it's about controlling the income. And this is why warehouses are the most underrated real estate investment. If you're serious about building wealth in real estate, you need to understand one thing. Warehouses. They quietly outperform almost everything else. First, the demand is exploding, with e-commerce, logistics, and same-day delivery becoming the normal. Companies need space, and lots of it. Warehouses are the backbone of that system. Second, lower operating costs compared to office or retail. Warehouses are simple, fewer tenants, fewer complaints, minimal build-out, and lower maintenance means higher margins. Third, long-term leases. Many warehouse tenants sign up 5, 10, even 15-year leases. That's predictable cash flow, something every investor should prioritize. Fourth, flexibility of use. A warehouse can serve logistics, manufacturing, storage, or even be converted into something entirely new. That adaptability protects your investment. And finally, from a CPA perspective, the tax efficiency of warehouses. Warehouses benefit from depreciation and cost segregation, allowing you to significantly reduce taxable income. So while everyone's chasing flashy assets, smart investors are quietly accumulating warehouses and building real, durable wealth. Quick fun fact about warehouses that might completely change how you think about them. Did you know that the average warehouse today holds way more value per square foot than many retail stores, even though it looks way less glamorous? Think about it. Your local mall might look shiny and expensive, but a single warehouse can process millions of dollars worth of goods every single day. So some of the largest fulfillment centers ship out over millions of packages in just 24 hours. And here's the crazy part. Warehouses actually have become so valuable that companies are willing to pay a premium just to be closer to cities. Why? Because being even 10, 20 miles closer to customers can save millions in delivery costs and time. So while office buildings and retail spaces get all the attention, warehouses are quietly becoming the backbone of the entire economy. Not so boring now, right? Thank you for sticking with the briefcase today. If you found any of those facts about the 5 pillars of commercial real estate confusing or insightful, please feel free to comment down below. If you enjoyed this video, make sure to like and subscribe. And remember, stay smart.